Yeah, I think what we're going to see is marginal improvements. I think both sides will want to be able to walk away and say they've had success. I think China need to move, and I think that Mr. Trump needs to come back to the US and say, I've made some progress. I don't think it's going to be the massive shift that many people had hoped for at the outset, and I certainly think it will be covered in spin. I think it's going to happen reasonably soon, and I think the markets need it to happen reasonably soon because it feels like we've baked in a positive resolution now.
Let's just get into a little bit more, because one commentator was describing the market at the moment as being almost in hiatus. Everybody's waiting out for confirmation that Q1 really was that bleak period that we had for 2019, that it's going to be much firmer, stronger from here, and some of that down to the mood music around what happens with the trade agreement between the US and China. Do you think we're going to see a fundamental change in markets to the upside if there is a trade deal, if there's pen to paper on a deal?
Well, it'd be hard to see that happening in fixed income markets. There's not much further that we can go. iTraxx crossover, our high yield index in Europe's trading inside 250 basis points. We rarely get to those kind of levels. More than half of European high yield corporates can now borrow for less than 2% per annum. That's an incredibly low level. We've been driven in this last phase by technicals, demand far outstripping supply. And those technicals are supported by the huge balance of negative yielding assets, the 10 trillion of assets. But I think that investors are getting more cautious. So I think the path up from here is tough to see. The thing I'm most worried about is the absence of things to worry about, which is the reason why maybe the pain trade is for us to go tighter in fixed income and higher in equity markets. But I think we've come a hell of a long way, and going much further from here rapidly is, I think, unlikely.
Where is that demand coming from in the fixed income markets?
It's coming from end investors. Pension funds have seen a really, really great ride for the last 5 years. They're sitting on almost close to fully funded balance sheets, and therefore they don't want to take a huge amount of risk. And so they're reducing their equity allocation and looking to increase their allocation to fixed income at the same time that there aren't really many assets that you can own that pay you anything. And therefore the number of assets that actually pay you anything shrinking means that everyone is fighting over them. We've seen a couple of deals over the last couple of weeks that don't feel particularly nice to own, but the demand for them has been insatiable. We've turned down several deals recently just on price alone.
On that point, I was reading through some of your notes, and you made the point that banks have become a lot more aggressive on terms and pricing when it comes to new issues. And should investors be stepping away from these new issues?
I think investors should be. Whether they can is really a reflection of how much they've owned of this rally year to date. And that was something that the equity guys were talking about earlier this morning, that there are a number of people out there looking like they haven't owned this rally sufficiently to be able to be conservative now. And that's a tough position to find yourself in, I think.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.